Hi, and welcome back to the channel. Today, we are looking at SoFi stock, a name that has been all over the headlines, and one that a lot of investors seem to be really excited about. To be honest, I have never looked into SoFi before, so I had to do a little bit of digging to understand what the company actually does and why it became so popular. So in this video, we'll break down what SoFi is, what makes it stand out in the crowded fintech space. We will go over its financials and, of course, calculate its intrinsic value. This is the third video in my stock analysis series, so if you've been enjoying these videos, make sure you subscribe to not miss out on future stock analysis. And now, let's get into it. So what exactly is SoFi? SoFi is short for social finance. It started as a student loan refinancing company, but today it evolved into something much bigger. It is trying to be a one-stop shop for all your financial needs, offering everything from personal loans and mortgages to credit cards, investing, and even banking services through SoFi Bank. Think of it as a digital bank mixed with a financial app and a stock trading platform, all under one roof. But what really makes SoFi stand out in the crowded fintech space is its land and expand strategy. Here is how it works. SoFi attracts a new customer with one core product, for example, a student loan refinance, and then encourages to use more and more of its services over time. This cross-selling model increases customer loyalty, reduces acquisition costs, and boosts profitability as users get deeper into the ecosystem, and the ecosystem is constantly growing. In just last quarter, SoFi added things like credit cards, alternative investments, and subscription service called SoFi Plus. They're also exploring crypto-based services like asset-backed lending and clearing, which could be a big deal if crypto gets more regulatory support in the US. They also own Galileo, a business-to-business platform that powers payment and banking infrastructure for other fintech companies. It's a bit like Stripe for banking, and it's helping SoFi to diversify its revenue outside of just customer services. All of this positions SoFi as more than just another app. We're trying to build a financial ecosystem, like what Apple did with devices, SoFi wants to do with money. Alright, from the business model perspective, SoFi looks like a great company. But a great business model does not mean great financials. So now let's dive into SoFi's financials and see if the performance actually lives up to the hype. So, SoFi stock is currently trading at around $12.4, and over the last year it's up around 70%. However, it has experienced a significant drop of around 30% in the last few months. It has an around 14 billion market cap, and their debt is around 375 million, which is not too bad. It is currently trading at around 32 PE. However, strangely enough, their forward PE is 47, which means that they are expected to earn less for the next 12 months than they did for the previous ones. This metric looks kind of strange. Now let's look at their detailed financials. When it comes to revenue, it seems like SoFi has great growth, growing from 270 million in 2018 to 2.6 billion in 2024. That's almost 10x in just 7 years. Now let's look at their net income, going from losing 250 million in 2018 to actually gaining almost 500 million last year. One thing to notice is that this is the first year that SoFi became profitable. I would prefer to see a longer track record of profitability, but since SoFi is a fairly new company, it's understandable. When it comes to financial companies, a really important metric is their net interest income. It's the difference between interests earned, for example, from loans, and interest paid out to depositors. And for SoFi, this metric looks really good. In 2018, their net interest income was around 260 million, going up to 1.7 billion last year. Truly great and really important for a financial company. Since SoFi is a fairly new company, I would really like to see their shares outstanding, because new companies tend to issue a lot of shares to fund their growth. And when it comes to SoFi, this metric is highly disappointing. They have been issuing shares like crazy.
Why don't you explain this to me like I'm 5?
To simply explain share dilution, imagine a company has 100 shares and you own 10 of them. And let's say the company earned $10 last year, which would mean each share gets 10 cents. Since you own 10 shares, you would get $1. Now let's say the company is planning to expand this year, and they're planning to earn $20. However, they need to finance their expansion, and because of that, they issue 100 more shares to new investors. At the end of this year, the company will earn $20, which is double from what they earned last year. But since they issued 100 more shares, you are still left with the same $1 profit, even though the company's profit doubled. This is commonly known as the silent killer for investors. Even though the company is growing, your part of the company is shrinking. So I cannot say I am a big fan of this metric for SoFi.
Okay, break it down in terms of, okay. I think I'm getting you.
Finally, let's check their free cash flow. Their free cash flow has been negative, and I kind of understand that because they have been growing really fast, so they need a lot of investments. Since those investments cost a lot, I kind of understand why they are diluting their shareholders and issuing more shares. Still, this metric is not really one that I'm fond of. Alright, now we checked their financials, let's see what analysts are saying about the company. So when it comes to revenue, analysts expect the company's revenue to almost double in the next 5 years. However, they are also predicting that their growth will slow down. When it comes to net income, analysts expect SoFi's net income to grow to $1 billion in the next 5 years. Considering they're currently trading at a $13 billion market cap, even if a company's price wouldn't grow for the next 5 years, they would still be trading at a 13 PE in 2029. Honestly, I cannot say I love that. Alright, let's look at the free cash flow. Free cash flow shows a much better picture. If analysts are correct, the company should reach close to $4 billion in free cash flow in the next 5 years. However, this big jump of 240% in year 2028 doesn't seem too realistic. After reviewing SoFi's financials, I have mixed feelings about the company. I see decent growth, however, I also see major dilution. Also, since the company is fairly new, they have become profitable only last year. So with all that in mind, let's calculate SoFi's intrinsic value and see if the company could be undervalued. To calculate SoFi's intrinsic value, I'll use net income. Last year, the company made around $498 million. Since I am fairly new to the company, I'll trust the analysts who were assuming around a 15% growth for the next 5 years. And for the 5 years after that, let's stay at 10%. Now for the discount rate, which is basically what we would like to earn, let's go with a standard 10% return. And for the terminal multiple, let's keep it at 20, which is fairly generous. So if all of these assumptions would come true, the current value of the company would be $17 billion, which is significantly lower to the current $14 billion valuation. Let's see what happens if we lower the terminal multiple to a more standard one of 15. The company's intrinsic value still comes out at over $14 billion, which is higher than what it currently trades at. So after running the numbers, it looks like SoFi is undervalued and we should all throw our life savings at the company, right? Wrong. While the intrinsic value calculation suggests the stock is cheap, it does not account for share dilution. And SoFi is diluting shareholders aggressively. If that continues, your slice of the pie will shrink. And since I used fairly generous assumptions in my estimations, I personally do not think that the stock is undervalued. For me, it is an easy skip, at least for now. But what do you think? Do you like the company? Maybe I missed something. Please comment down below. If you enjoyed the video, consider subscribing and hitting the like button, as it does help to grow my channel. And as always guys, thank you for watching and I hope to see you in the next one. Bye.